Hello, I am Minjanon, a college student in the United States. On May 3rd, Minjanon's special broadcast about United States stocks will begin. Today we have a special guest who always comes to mind on weekends, Mr. Kim In-jung. Hello, Mr. Kim. Yes, hello, Mr. Kim. It's nice to see you. Yes, I'm really glad that we can meet like this for 2 weeks in a row. And I really liked the atmosphere in the United States last week, so I wanted to be in a place where I could prepare for another broadcast. Still, I can't help but feel a bit anxious. And as I mentioned in the last broadcast, it's impossible for investors not to think about risks. There's a possibility that a recession could occur due to the influence of the Trump-related issues, and that's why many experts are very cautious. Also, we are currently pursuing normalization, but it hasn't been easy. The gross domestic product figures have been released, and the market performed well. When the United States economy shows strong growth like this, is it right for stock investors to follow along? I'm also trying to save some money. So, how can we minimize the risks of investing and protect our assets while still aiming for safe investment returns? Let's continue to study and discuss this together. Today is the last broadcast of the investment risk management section. Can you briefly summarize what we've covered today?
Yes, investment.
Risk, yes.
I'm going to skip the part about value and focus on the part related to market timing today. At first, there were mainly parts related to stock selection. I talked about the fundamentals of the company and its internal risks, and then I discussed the current cash flow and how to check the cash flow properly. Last time I talked about how to avoid risky stocks even if you want to buy good stocks, and how to identify and avoid the risks when you are tempted to buy risky stocks. In the final part, I'll discuss how even good stocks bought at the right time can underperform if the overall market is overvalued. Less favorable stocks may fall even more. Timing your market entry and considering the overall market valuation are crucial factors. Despite carefully selecting stocks I thought were good, they can still decrease in value, causing losses. Conversely, when the market is strong, nearly any stock seems to appreciate. The market occasionally behaves this way. So, depending on the market, your returns can fluctuate a lot. That's why it's important to pay attention to the current market valuation and adjust the proportion of stocks in your portfolio accordingly. Today, I'll talk about these practical aspects, looking at real data and sharing my thoughts on which parts you should focus on.
Today's broadcast is going to be interesting, especially these days. The market cycle is starting to change a bit. So in 2020, 2022, and now this year, which is 2025, we've seen three big market swings in just 5 years. That's why I think it's becoming more and more important these days to understand and respond quickly to these kinds of market cycles. Then let's get started with today's guest, Kang Uy, and let's begin.
Today, I would like to conclude by presenting the final solution on how to balance stocks and cash using the market score. So, by keeping an eye on the overall market trend and the market score, you can decide how much to allocate between cash and stocks depending on the current market situation. This way, we've structured it so that you can get more practical help. When we invest, there are many terms related to market timing. But in reality, if we choose only the terminology without understanding the market, it doesn't really help. There are times when you have a lot of these thoughts. But when you actually look at the big investors or these self-made people, they have a completely different perspective and they invest based on fundamentals. So is this really the right way? If you just stick to the basics, I wonder if I won't fall behind, but I tend to just follow the representative 3 or so momentum stocks. More than 90% of investment performance is determined by asset allocation, not by stock selection. This is what the data shows. Secondly, if you look at most successful investors, they also focus on asset allocation. If you dig into who actually does this, you'll find people like David Swensen. He was the chief investment officer who managed Yale University's endowment fund. As far as I know, starting from the early 1980s, he managed Yale's fund for about 35 years, and during that time, the average annual return was 13%. That's an amazing achievement. That's why he's called the Warren Buffett of the investment world. In the portfolio and management field, many people say he's one of the best, and he emphasized the importance of asset allocation. In fact, in 2021, it was introduced to another country first, but after that, it was also introduced to Korea. This book by David Swensen is also available in Korea. It's a book called Portfolio Success Operation, and it's quite a thick book with a hardcover. So just looking at the book makes you feel a bit intimidated.
But this.
Before, in the past, Mirae Asset Securities Research Institute published this book, not a regular publisher.
So now.
It's out of print now, it's out of print. I had a hard time finding it in Korean. Those who are good at English can search for it on Amazon.
If you look it up, David,
You can read this book by David Easton, but since it's hard to find in Korea, I searched for it at the broadcasting station's library before the show. There are some translated versions and summaries.
they're quite expensive.
Originally priced at 28,000 won, the out-of-print used book now sells for at least 38,000 won, with some listings around 100,000 won. So when you look at books, those with value tend to become more expensive as time goes by and they go out of print, while books without much value are often sold at a discount for a short period, but sometimes you can't even find them being sold at all. This person's book has a lot of loyal fans, so even in the middle, people try to buy the portfolio, and those who want to do that are usually investors who think the size will get much bigger. Those in asset management or related fields and even other areas will likely find this author's book very helpful.
Next, I have a book about asset management as a reference. This is the Bible for American stock investors, and on top of that, it's written by David Swenson. If you're curious, try looking it up. I think you'll like it. Please continue.
Asset allocation is more important than stocks. I'm a stock investor, but if you look at the reality now, it's like I'm an exchange-traded fund creator. So instead of individuals picking stocks, he made ETFs that put together those things well. Investing directly in individual stocks can be challenging, but it is achievable. We often think that we can do better at picking stocks, so we tend to go in that direction. So whether you have more cash or more stocks in your current situation, this is also a matter of asset allocation. The people mainly speaking here didn't just talk about stocks, they discussed asset allocation involving various currencies and commodities. For individual investors, even when only investing in stocks, it's still about allocating assets between stocks and cash. Whether I hold a lot of stocks or a lot of cash, just by adjusting these, I can clearly improve my returns. That's how I see it. I tried to summarize the trading patterns of actual investors. I used to give many lectures, which led to repeated investment failures. If you look at the typical pattern, you buy a small amount initially, as shown by the category and index. So you just try it out with a small amount, maybe 10%, maybe just 5%. But the things you buy in small amounts tend to go up strangely, and you gain confidence thinking, oh, maybe I was right. A lot of the things you buy don't go up, but the ones you buy just a little of tend to go up. So you wait, and if you see it go up this much, you think your judgment was right. Then you end up buying 2 to 5 times more than your original purchase amount. At first you listen to your intuition and buy just 1 million won worth, and then you realize your judgment was right. Then you buy about 2 to 5 million won worth of the same stock. Then, at that point, the price usually goes up steadily and it keeps going up to this extent. At first, you might think you can handle the loss, but as it gets bigger, you realize you need to stick to your original plan and cut your losses. When reviewing your portfolio, you notice some stocks have risen, causing you to regret selling them. Upon closer inspection, you realize you did indeed sell those stocks. You question why you frequently buy and sell in this manner. I knew it. Then you end up buying it again. Frequent trading can lead to losses when stocks drop. However, fear of missing out on a potential rebound often prevents cutting losses, as traders imagine the stock going up after selling, resulting in holding onto losing positions. If you should cut your losses but don't, you end up becoming a so-called long-term investor. That's how people become long-term investors. Many investors who experience losses unintentionally become long-term investors. They originally didn't intend to hold their investments for an extended period, but end up doing so involuntarily because they can't sell. So the way to break out of this pattern is to look at the overall situation from a macro perspective. If you have data that shows how the market is moving, and you can refer to that data to make decisions, that would be helpful. That's how I think about it. So, among the indicators that evaluate market trends, this is the one I like the most. And more than any other data or numbers, I continue to pay attention to this indicator. How are things right now? How are people feeling right now? There's nothing as uncertain as judging the valuation of the market. So this chart is a very important indicator for the cycle we're experiencing. Sir John Templeton, whom we respect, explained how bull markets are born, grow, and die. He said that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. That's how the market cycle works. So, when people say things like, oh, the stock market is over, if you invest in stocks now, it's all over, the economy is ruined, I've heard that the country is going bankrupt, don't invest in stocks, don't even think about it, just stay away. That's actually when the bull market is born and starts. As prices rise, people grow skeptical, thinking things might be improving. With continued price increases, more people accept it and consider investing in stocks. However, when too many people, including those who never invested before, become interested and discuss stocks, the bull market is nearing its end. So, look at the people around you, or the stock community, YouTube and television. Are they talking about pessimism or are they talking about optimism? So, based on this, the short-term highs and lows are determined by sentiment. So now I also think about this a lot. Whether I'm currently in a happy situation or I'm feeling anxious, or even if I look at the charts and try to judge the market's direction, I don't think there's any data as accurate as this. So, the Choice Awards Max Score was developed as a service after being inspired directly by the tone and sentiment of Templeton's words. So how can we score that, and how can we score whether we're happy or not? It's not just simple emotions that make money, but rather, it's about looking at the situation objectively and asking if you can say it's undervalued at the current price. That's why we created Market Score, and by objectively scoring that situation, that's exactly what Market Score is. So today I'm going to talk about the background of how Market Score was born. When I first started broadcasting, I once talked about the background that made me create Choice Table, and Market Score also has a similar story. I wanted to tell you that I created it out of the desire to solve the concerns about the overall market and see if it could be improved. Recent cable news network and Fox News coverage shows many indicators of the fear and greed index. And it's being used a lot in the media, and many analysts in Korea are also using it. So if you look at it, you can see that it's become a kind of standard. So I also use that index and adjust my portfolio. And these things are quite reliable data, so I also refer to them a lot. At first I was a bit skeptical, but I thought there must be a reason for its popularity. So after evaluating it, I decided to develop my own scoring system as well. So now, since the brands are so different, CNNF is a very well-known and credible company, and Choice Awards is now mainly known through the American television channel. But back in the day, it was also important to have that kind of credibility for companies like ours. So, in order to do that, there are parts that need to be supplemented in the long run so that the explanation can be made more clear and people can trust it. But recently, I was told by the representative that I was doing a good job, and I felt quite proud. That's how it is for me, and that's how it is for our team as well. We've received a lot of positive feedback both in voice and in video. So I thought we should make it even better, and next time we should match the tone even more accurately. That's how we kept listening and improving. Let me explain about this difference in my own way. Cable news network and Fox News each have their strengths and weaknesses with clear advantages and disadvantages. Today, I want to focus on the differences between them, assuming you're already familiar with their strengths, so I never said that Choice stock is unconditionally better. There are also things like Seeking Alpha, and each has its own strengths. Seeking Alpha has its advantages, service providers have their own strengths, Choice stock Max Score has its strengths, and CNFN's public disclosure analysis has its own advantages as well. Understanding the principles behind the focus allows you to decide when it's better to look at one thing or refer to another. That's how you can utilize it effectively. But right now, fear and greed are more important than just fear or greed alone. Yes, that's right. First, the cable news network and Fox News fear and greed index is heavily focused on the current market sentiment. So it shows the emotions of many people as they are. Today, it's very strong, but that means there's a case where it's at the top of the extreme range without any hesitation. But over there, it's with the pain, and it's like this. So, in my heart, it's not pain, but why do people call it pain? This difference is clearly there. That's because Choice Talk focuses on the average of the market at the moment. So, just because the market is overheated right now or not, It's not a metric that reflects the state of mind of many people. So if you want to know the overall market sentiment, it's better to look at the cable news network or Fox News's Fear and Greed Index, and I focus on the overall market valuation. So, even though it's called a fear index, it's not just about fear. Fear can appear at high points and it can also appear at low points. So when you want to focus on valuation, it's good to look at the Schiller PE ratio. Next, in the case of the cable news network Fear and Greed Index, they publicly disclose the data for the 7 items that make up this index. So if you look at the overall data, it's focused more on technical analysis or momentum analysis. So if you look at the S&P index, things like moving averages or these kinds of charts, the adjustments are made very closely. So that's why there are a lot of divergences, or sometimes things get closer together. Because of these factors, psychologically, these indices tend to form these kinds of patterns a lot. Also, if you look at the 7 items, the most recent data is from April 29th, when both the exploration and fear indices came out the same. If you compare the 7 indices, does it make sense to see both extreme fear and greed at the same time when you look at these indices? They combine the 7 indicators into one score, but each message can come out differently. In cases like the market score, the quantitative analysis is based on CNNF, and there are items and factors unique to technical analysis and momentum analysis. So those items are included, and in addition, there are some parts in market score that are for valuation analysis. This market score includes sections like industry analysis and valuation. So we analyze the fundamentals and earnings separately and then combine them to create the score. The score changes not just due to supply and demand fluctuations. That's the second point.
That's the difference. And then
Next, the third difference. I watched a video where the representative was broadcasting and the customer asked a question and the representative answered it. In that video, the representative explained why the max score was set at that level. I heard that explanation, but I still think there is a correlation in that part. So, in the case of cable news network frequency modulation, the difference between exploration and sharing is very small. So, after that, if there's anything that I see as a minor detail, I'll explain it further with additional data. Even in places where Jisoo says we are at a high point, there are cases where exploration and sharing change quickly. So, whether it's at the top or at the bottom, greed and fear keep coming and going. As you can see, even though we entered the bubble and bought stocks, the market's potential to reach new highs still exists.
That's right, because
in the case of cable news network frequency modulation, it's not about measuring valuations. That's why, when we only look at the current emotional state, we might say it's a high point, but in reality, it's just a comparison of fear and greed. It's fear at the bottom and it's greed at the top. Because there is no basis for this, errors can occur in this part, and that's something to keep in mind. In cases like that, greed and fear levels are relatively high. Usually, it takes about 3 to 6 months to reach this kind of flow. Depionim. You mentioned earlier that psychological cycles are longer these days, sometimes taking 6 months to go up and 6 months to go down, which is nearly a year and quite lengthy. This cycle takes nearly a year to complete and repeat. Therefore, the Zhonhui score reflects both supply and demand, making it difficult for both indices to rise simultaneously when transactions are sluggish. The Zhonhui service market score reflects the long-term supply and demand trends in stages, so it should be viewed over an extended period. If you grasp the traits of each and examine the score graph, you'll gain a clearer understanding. When the index is highly volatile, we attempt to smooth it out to facilitate interpretation. No, it's always the same. It's the same today, it'll be the same tomorrow. And it's like that every day. This scenario is possible. If the company's value keeps rising, the index will increase, but volatility will persist. Conversely, if it doesn't, volatility might decrease due to our exposure to market fluctuations. Next, using this score as the final step to adjust stock ratios or cash ratios is quite limited. However, I personally find this part quite effective. In fact, in the last lecture, or rather, at the very end, I actually used this score to show you how to utilize cash and stock ratios. I wanted to share a story about someone who benefited from this, so I brought it up to explain it to you.
To add a bit more explanation, I said that one of the unique features is that it focuses on emotional states. This seems to be the key point. In the case of cable news network, there are a lot of options among the 7 layers that can be used to control the sharing of weights. For example, there are a lot of bins, and each bin can actually look at the options and make decisions. And among those options, there are more and more parameters being managed. So when you want to adjust things like price, you can quickly and simply select only the necessary options. And if the popularity of certain parameters increases, then the number of options will also increase. That's why options are structured this way. So this fear and greed index can change at any time, so it's not something you should rely on completely. In situations like now, it's just showing us how much the market sentiment is fluctuating in the short term. And when I look at it, the investment period is usually about a month. Some traders look at it for 6 months to 5 years. However, for such long-term use, it's not a very useful indicator due to its volatility. Personally, I don't really use it.
So now I'll briefly explain the parts related to this index. Then I'll show you some data to explain how much the actual index can predict the future based on this indicator. This data has been generated since June 2022, when I started producing the score myself.
That's right.
Now it's 2025, and since it's May, there is a lot of data.
That's right, just this.
But I never thought the accumulation would take this long. For more accurate data, a longer uptrend, downtrend period, or wider range would be better. For now, let's focus on the data from the last 3 years that we produced, specifically looking at these two. This is marked in gray, and then 20 days later, the S&P index's entry is marked in blue.
And that's 20 days later.
So it's about 3 weeks, which is why we use 20 days. If you check Zhongyi's data over the past 3 years on average, the period between the peak and the trough is about 3 weeks. If 3 weeks pass, usually either the fear period ends or the greed period ends. That's why we set it at about 20 days after that. We check the data to see what happens next and draw a chart. So if you look here, this is the line that's currently being drawn. This red line is the level where the line is currently in the fear zone, and then this gray area is where it's currently in the recovery phase. After 3 weeks in this fear phase, you can see from the data that the S&P index tends to rise by about 10% in the following market. So when the fear phase gets longer, even on the YouTube channel I run, I say that this is the time to stop being afraid and start buying stocks. I think that's what you should do. And that's why I introduced those stocks. That was the reason they were included in this part. As the fear persists, you can observe the index rebounding in certain areas, which is clearly visible in the data presented here.
It's there. And then...
If you look at this time as well, after entering this fear, the index went up about 9 to 6%. So, starting from April 7th, when the market entered a state of fear, if you look at the data, you can see that for about 3 years, the market has continued to move in a similar pattern. This suggests that the market tends to recover, so the next time a similar pattern appears and fear comes in, we can know that this is the time to buy. But even so, at that time, there was different news coming out, not this fear sentiment. In the past, news reported negative gross domestic product, but when we were actually fearful, gross domestic product wasn't truly negative at that moment. So events that keep making us hesitate and unable to buy continue to happen. At that time, you have to hold on to this indicator and buy right away. That's when you have to buy. You have to buy when you feel like you really don't want to. So at times like this, I recommend buying ETFs. In times of uncertainty, it's hard to trust individual stocks, as even experts can't explain their fluctuations. Instead, buying an exchange-traded fund that covers a whole sector increases your chances of catching the stocks that will rise. Stocks don't all give buy signals simultaneously. If they did, that would mark the bottom. Instead, some stocks show signals earlier, while others show them later. During this period, gradually enter the market. Then if you want to pick the best stocks, you have to be patient. If you buy the S&P 500 exchange-traded fund or something similar, and if you invest a little more aggressively, you could even double your money, but tripling it would be too risky. So, if you just buy the exchange-traded fund index, you can expect a return of about 9% per year on average within a month. Over 3 years, you can expect an average return of about 25%. While 9% may not be achieved every time, the overall probability of reaching this average is quite high. So right now you might be out of stocks and in cash, but if you decide to invest again in the future, you should start by buying ETFs first. When the market rises, large cap stocks lead first, followed by mid cap and small cap stocks rising later, based on the order by sector. Remember, don't buy those stocks yet. Stocks that have been falling for 3 months, 5 months, or 10 months, don't buy those. If you look at the buy signals, you'll see that the ones at the top are all stocks that have already rebounded. So, please focus on the ones at the top, not the ones at the bottom. It's better to invest in safer and more stable companies. So if you look at it that way, it's good. On the other hand, if you look here, this is already in the consolidation phase, the consolidation phase, the consolidation phase. Currently, the greed phase index is at 0, indicating a negative value. In contrast, the index is 0 without any negative value in one instance, while in another, the greed phase index is negative without any minus sign. I get overly attached to certain stocks, making it difficult to sell them. As a result, I hold on to declining stocks for too long. Still, it's not a market where you can just blindly chase after profits. So when we save money, we put aside cash for emergencies, and the cash we used to set aside, we end up using it during times of crisis. I think that's a very important factor that affects the overall portfolio's returns. So the reason we look at this data is not just to see the Joe Max score itself, but because the meaning of this score is to actually predict and track the S&P returns based on the grade of this score. That's why I'm showing you this chart to help you understand what it means as a leading indicator. So don't be too fixated on whether Joe Johnsu goes up or down or whether it's good or bad.
Just wait.
Since there is this kind of meaning, if you check it every day and see how far it goes, at this stage you should check your current status a lot. If you use it like this, I think it will be good. It's a detailed analysis of the screen in front of you. If you look here, both are showing a similar trend, and if you look at the graph of cable news network, Fox News, both are moving almost the same way. The original asset itself is showing a pattern similar to the trend of the choice index and cable news network. Fox News is also moving in a similar way. Customers may have initially thought they were sharing the same thing, but it appears to be different upon closer inspection. So I went into cable news network Fox News and received the data separately from the market data at that time. I compared them and they were all similar. That's why I used both cable news network Fox News and the other data, and I checked through the chart how they were being drawn separately. So if you look at this point in time, this area here is called the panic zone, and the current area is also called the panic zone. When the index was here, it was also called the panic zone, but in the case of cable news network frequency modulation, it was actually the original area. So from here, it's no longer panic, it's just normal. The reason is that liquidity didn't expand significantly, and as soon as the moving average started to slow down, it was a signal that the market wasn't expanding anymore. And then if you look here from this point on, it seemed a bit weak, but here it's more of a consolidation phase.
This is fear.
The stage, this blue color, is currently representing CNNFN. CNNFN adopted this color, and this blue color was originally used by Joyce for the main blue color, so I expressed it as Joyce blue, but CNNFN called it Gongpo blue at this time. At the end of December 2024, they called it Gongpo blue once, but Jisoo quickly recovered. For me, it wasn't a fear stage, but just a process of fear. That was the situation. But Jisoo quickly rebounded, and since it was still a fear phase, if you had bought during the fear, you would have survived. According to CNNFN, at that time, it was a situation where you had to keep buying. And then, the stage where CNNFN entered the fear phase again was in February. Starting from February 25th, the fear phase continued until March 2nd. During this period, if you had bought during the fear, the S&P index would have risen like this. During this period, it went up by 48%, then rebounded, and after that, when Jisoo fell again and fear returned, that's when CNNFN started to indicate fear again. So, when we talk about fear, it's not just about a low fear level, but rather about reading the extremes. So, the level in the same chart, the level that corresponds to the complete fear stage, is not just fear, but the level that was shown on March 28th. So from March 28th to April 21st, the bottom range was about 76%. So if you add those two together, the drop was about 11 to 12%. And even after the fear came out, the index continued to fall. So looking at it by sector, the semiconductor industry dropped by 30%.
Can't do it.
Some struggling industries saw declines of 50-60%. So now you see why people say you have to survive in the stock market, right? Earlier, I talked about valuations, and since valuations are not included in the bubble, it can be dangerous in this kind of situation. So, let's talk about these parts. The point when I officially entered the fear stage was April 8th, and then I got out of it on April 22nd. So I entered the fear stage at that time. And up until now, the drop in the index from the time I entered until I got out was about 6.1%. So like when you look at these parts, our confidence may come back a little bit, but it's definitely still in the fear stage. Despite the belief that the market is fully saturated, there are still undervalued industries. When many industries are in this state, it's important to remember the advice: buy when there's fear. My max score is a good metric to use when allocating assets or comparing investors. If you look at it this way, it seems like a good indicator. I'll briefly explain the investment strategies by section. You can check the max score data for all the details on the pages. Since everything is there, you can refer to it directly, and I'll provide a simple explanation. I'll explain the market situation and investment strategies for each section like this. The market situation is the emotional state of people, as reported by news outlets like Cable News Network or Fox News Understanding. This perspective provides clarity on the current market climate. This can be seen as a stage of blind optimism, reckless risk-taking, or fearful asset selling. Understanding this perspective provides clarity. Joey is attempting to explain the general process of this investment and provide the reasoning behind his decision given the specific circumstances. Is the ancestor of price decline? It has potential. So instead of just focusing on the number of new customers, it would be good to actually implement it and make sure the current ratio is accurate and make the message clear. But at times like this, should we hold on or sell, or should we buy more, Siolma? If you stick to the same pattern, you get stuck. Repeating what you did before prevents breaking away, leading you into a trap. This is the moment when you feel happy for no reason, when you feel happy just because things are going well, and that's when greed starts to creep in. That's what we call a greedy mindset. If you take a proactive approach and actually make the move during the second phase, you'll feel good. That's the message of legendary investor John Templeton. Keep making those moves from now on. You might feel a little anxious or greedy, but if you keep taking action and keep your cash flowing, you'll feel good. That's the message he's trying to convey. Next, pay attention to the normal phase. It's important. The normal phase may seem ordinary, but it's when investors make decisions. This stage is where the current trend strengthens and investors watch closely. So that if you look at it from the perspective of supply and demand, the normal phase is the section where things move upward, and you can see it as the section that leads up to the peak.
And on the contrary,
If you look at it from the perspective of supply and demand, when it falls from normal to fear, the possibility of it dropping all the way to panic is considered to be high. That boosts Gu Hyun-jae's endorsement. So when I appeared on the show in February or March, was Daepyo Nim already feeling anxious? But I think I was more cautious when I said that.
there was a gap, and then
It was usually when I was trying to express my thoughts. At times like this, it's best to just pick the lowest risk option, and even if you get a little less, it seems better to be safe. The word data is not a feeling I felt, but rather it means that I am showing you the data. So usually, the section is in the middle of the trend going up or down, and if you look at it this way, I think it will be good. The current section in the middle of the range doesn't indicate an immediate sharp price increase, but a slight upward trend in the main tendency. Interpret it this way when making investment decisions, and consider the opposite interpretation as well. Just like that, even in a normal situation, there can be more volatility. To put it simply, the cycle starts from the fear section, goes through the normal section, and ends at greed. Then, when it comes down from greed, it goes back to fear. By sector, stock prices can fall from high prices to fair prices, or from high prices to low prices. This kind of situation happens very often. It would be good for you to know these things. In the case of real estate, we directly check the short-term price. Monitor the sales market now. I watched the sales, and during the fear period, few people buy stocks. Only YouTubers and some media discuss it. At this time, I try to buy at the lowest point as aggressively as possible. And it's not good to use words like extremely undervalued, optimal, or extremely cheap. I don't use those words on my site.
If you gain confidence,
When not used well, if you hold at the public offering and sell within 3 weeks, the S&P usually rises 2-3%, and those who do well see average returns of 9-10%. However, if you don't sell at this time, the index drops.
Sen Iyun.
That's how it works. so sometimes I was able to hold on without panicking. This page is linked to the max score, so if you press the detailed information, it will come up as it is. If you refer to the previous examples by stage, I think it will be helpful. This is how max score actually appears. If you look at it recently, this is the exploration stage.
The stage indexes.
It's the period before the bull market in December, and then it usually goes up. On the broadcast, I don't think I'm as smart as Lee Dae-chul. I think I can do better, so I'm looking forward to it. I did it, but even though it seemed right, I was still nervous, so I wondered if I should really make a decision like this.
I was nervous, but in this situation,
If you hold on to the stock and just barely get out of the bear market, and then you go up a little more, you might see a 10% increase just by holding on until the next resistance level. Even today, if you look at the market as a whole, it's only up about 1 or 2%, so you might not notice if it goes up or down. In a recovery or upward trend, stocks often rise significantly initially, then fall back, but if they recover to a certain level, it's characteristic of a recovery phase. So if you look at it for a short time, it might not seem like much, but if you look at it in terms of the index, it's already up about 12%, maybe even 13% at most, so it hasn't gone up that much yet. So this time I think the upward momentum of the index will be limited. Even I, after a while, if it goes down a bit, I wonder if it will go up again, and I get anxious and worried. So from here, starting from the past, this is the section where the rate of return increases dramatically. When you find yourself obsessively checking your account daily, wondering about today's and this year's gains, and many others are doing the same, it's usually a sign that the market is peaking. Be cautious when you have such thoughts. I don't want to check my account, honestly.
then that's the time.
Psychologically, the best time to buy stocks is when your mind hesitates, despite it being the optimal moment to invest. At this time, it seems good if many people put a lot of their cash into bonds. In the end, for things like choice and maximization, how you allocate your cash and stocks in the middle will be important. This is content that hasn't been shared before, even in paid services. It's only been an idea until now, but I'm revealing it for the first time on Mijihun television. So if you try using it like this, it should be good. I classified investors into aggressive and conservative stock investors. Aggressive investors typically invest all their cash and stocks into the market simultaneously, while conservative investors tend to divide their investments and enter the market incrementally. These are the two investor types I wish to discuss. I arranged it into high risk and high return and low risk and low return categories. The market score is highly volatile, so when the market score drops to around 85 or 80, that's when people start to get scared and pull out of the market. It dropped below 80. Then from here, I should keep about 80% of my assets in cash and be cautious. For long-held stocks, start gradually selling them to secure profits. Then look for opportunities to repurchase when the market stabilizes. Increase your cash holdings. On the other hand, when the stock price rises significantly and stays high for a long time, that's when the price to earnings ratio goes up from 12 to 13. I recommend keeping 13% of your portfolio in cash and investing the remaining 87% in stocks. This is an aggressive allocation, so if you're cautious, consider the cash ratio as your score and keep it higher. Always have some cash in your account for emergencies. Even if the price is low, I advise against investing 100% like this. Conservative investors are more cautious than most, allocating less even with a high market score. For instance, with a market score of plus 40, they may only allocate 0.7. However, this can vary based on individual circumstances and risk tolerance. You can also use 0.8 or even 0.6.
And the key point is,
If you look at it recently, there are a lot more products that are more aggressive than conservative investors. So if you look here, the market score is 0. So in that case, the cash ratio is 0 and aggressive investors invest 100% in stocks, but conservative investors, even in that situation, still keep about 28% in cash. And if you look at the chart here, even when the score was only 75, the cash ratio was a little higher, around 80%. So basically, the style of operating with a little more cash is the conservative investor. When the stock market rises, the portfolio and stock values grow, benefiting investors. After the portfolio grows, the period can extend slightly. Investors typically review data for about 3 out of 20 weeks, but it can sometimes take longer. So, aggressive investors have almost no cash left after investing everything, while conservative investors still have about 20% of their cash remaining. So, when a crash happens, they still have cash on hand. So if the downturn lasts longer than expected, conservative investors have the advantage of being able to buy more at lower prices because they still have cash left. That's the strength of conservative investors. By arranging the screen like this, it helps many people understand more easily. After capturing the screen, if you use the joystick in the middle to try out the mass score, I think it will help you a lot.
First of all,
For the sake of education, I tried to keep this lecture as simple as possible.
Here, dividing by gender is offensive and discriminatory. In reality, some of the results may be partially different, but for the most part, unless you are an investor or a manager, the employment situation is likely to be more important. Among those who have made promises, if there are retired individuals, they have no new income coming in due to their retirement situation. At that time, even if you used to be an aggressive investor in the stock market, you need to take a more conservative approach. I'm usually very passive, but if I make a promise, I keep it 100% of the time. You never know when you'll have the chance to make up for it, even if you try to be aggressive later. Rather than investing too conservatively, I think it's better to take an aggressive investment approach. That's the way I think about it. And earlier, Mr. Kim In-jin also said something very interesting. If we move down to the bond market, we know we have to buy stocks. But if we move up to the stock market, we know we have to buy stocks. But even knowing that, there's a clear reason why we can't actually buy them. At that moment, the reason differs. If you make the same mistake for the same reason, you can learn from it, but you keep making the same mistake again. One time it was because of electricity, another time it was because of the virus, and another time it was because of the relationship. So when something comes up in the news, it's always for a different reason each time. That's why during the past month on the show, I kept emphasizing that this time it's not the same as before. So, since humans are emotional beings, even if the logic is clear, if you only look at the situation in front of you, emotional judgments can often be made. So even though I tried to be careful, I kept thinking that this time wouldn't be different either. That's why I realized once again how important it is to keep that in mind. Joe, oui?
Even if I just turn my face to the side, I try to look cheerful.
Shall I show you the screen? Yes.
On the screen here, the mock test score goes up to 41 points, but if you look here, all the content is provided in this form. As I mentioned earlier, this is the current market situation and investment trends, so please refer to this. Here you can see how the market score has changed, and we are showing you all of this. So, by looking at it this way, you can check together with everyone whether the current market is a difficult one or not. Next, I created new short-term and mid-term buttons for the exponential moving average chart on the main page so you can check them out. If you look here, one is for the short-term and one is for the mid-term. Basically, we used to look at the 1 year and 3 year charts, but when you look at the 3 year chart on mobile, sometimes it doesn't make much sense because it's too compressed. So, for the short-term chart, we made it so you can see the 5-day, 20-day, and 60-day lines.
so here,
So now, for cases like 5-day line disappears on the day when the 21-day line is removed. For those who want to see it in the short term and those who want to catch the timing of buying and selling, it's good to use this chart. So if you want to get buy and sell signals more quickly in the short term, this chart is best when the stock is in an uptrend and entering a consolidation phase. You can get a faster buy signal by looking at individual stocks, but you need to make sure the signal is reliable before you buy. I'm in the fear phase, but I want to buy stocks now. Though no clear buy signal initially, during a fear period, the index could rise by around 10%, with individual stocks potentially rising even more. Instead of aggressive buying, you can observe the market using a simple method. Draw a line between the 5-day and 21-day moving averages and watch the price movement. This could be the most effective way to monitor these markets. Conversely, the market doesn't immediately rise after the panic phase ends. Instead, search for short-term bullish signals and trade accordingly. The market remains expensive, making further index gains difficult. With only around 4 stocks rising, the market cannot be considered strong. But if you happen to get a profit in the short term, that means you've already made a lot of gains in a tough market. So it's better to quickly cash out and move on. That's why a short-term approach is good in this situation. Next, if you look at the midterm here, you can see things like the 20-day and 60-day moving averages on the chart. That's why the chart is set up this way, and the 21-day line is the short-term line. So for those who look at the midterm signals, and in cases like this, those who look at the midterm signals probably bought at this point. And here, they didn't sell right away, and then they bought again later. Those kinds of patterns. Looking at the midterm,
People like this.
rather than focusing on the short term, these individuals often prioritize the midterm, targeting mainstream categories or those with a favorable market score. They typically adopt a mid to long term approach, but when the market is booming, they may also employ a short term quick in, quick out strategy. Starting from the breakout, the midterm is usually better than the short term. Short term can break down quickly, but midterm tends to be more stable. Currently, it's best to maintain a midterm perspective when assessing the market up to the top stage. But in the short term, if you look at it from a very close perspective and respond quickly, that might actually be better. So this time I changed the exponential moving average chart to set new midterm and short-term periods so that you can use it more practically. I made these changes for you this time. So I think it would be great if you use it a lot. And as I mentioned before, since our app is available on both iPhone and Android, please download it and use it a lot. I think you'll find it very useful. Yes?
This, during the period of Lee Dongpyong Yoon Seon, I personally made a request to the representative, and thank you for carrying it out like this. Is there any reason why you can't use this item? Choice stocks' continuous evolution and addition of necessary features make it suitable for both beginners and experienced investors. The representative and development team should continue improving it step by step, which is Choice Stock's greatest strength. There were some things I was curious about regarding the Lee Dongpyong investment method. Because it didn't fit well, I couldn't use it properly this time. Looking back, I felt a bit regretful, and I think some subscribers and members might have felt the same way. I'm wondering if I can do better next time, so I have these concerns. Stock investment isn't something that ends in just 1 or 2 years.
Continuing on, the cycle is
Going to repeat. I always have the thought that if I do a little better next time, things will work out, so I try even harder to do better next time.
today?
Another hour passed as I focused intently on the greenhouse, not even noticing the time. For the next broadcast, I'll try to bring new topics and suggestions. Thank you for your hard work.
Yes, thank you.
Thank you very much. Yes, thank you. Yes, thank you.
Thank you.